It feels like the fact that we're even talking about the resilience breaking down or 7% even re-entering the conversation is kind of had the bond market on its head. What is this bond market telling you?
Well, I think it's getting more balanced. I mean, I think I've been very encouraged. In fact, we say at Vanguard, bonds are back. We have real positive interest rates, meaning over and above the rate of inflation, which has been the exception for some time, right? So that's a very positive environment. You're starting to see, another theme I would say is boil the frog. We've had to see the long end of the curve start selling off as it bakes in a little bit more of this higher for longer perspective. I think we're closer to the end than the beginning of that. And again, this is coming from having said that for some time. So I think we're a more reasonable environment. The short end of the curve is obviously very high. Is the Federal Reserve and other central banks done? I think they're close to it, but if you push me, they probably have one more hike in them.
Interesting. Sharing the view of Neil Kashkari overnight as well. Let's talk a little bit about the comment you just made. Bonds are back. Why are they back, though? Especially if we're talking about this resilience breaking down at some point, cuts coming down, that yield that was so juicy. How juicy does it stay?
Well, again, that there's ups and downs over what the neutral rate is. So that gets into that wonkish debate that no one knows exactly what it is, but it is not what it was pre-COVID. And so that means the risk-free rate is higher than what generally has been the past 10 years. So clearly that means that's positive over and above the rate of inflation. Again, it wasn't that long ago when there was a concern of secular stagnation. Most bond markets had zero negative interest rates. So I think this is the best financial development in at least 15 years. And that's, I think, what we're starting to see in the bond market.